Thank you for joining us on today's episode of Tax Matters. I'm Chamaka Ohawichi. We begin the episode from Revenue House in Abuja, where the Managing Director and the management team of the Nigeria Export Processing Zones Authority came calling on Wednesday, the 8th of June 2022. Purpose: the signing of an MOU between NEBSA and the FIRS. We'll recall that on Wednesday, the 24th of February 2021, the authorities of the Oil and Gas Export Free Zones Authority signed a similar MOU with the FIRS. This was against the background of the amendment of the Oil and Gas Export Free Zones Authority Act and the Nigeria Export Processing Zones Authority Act by the Finance Act 2020, which made it mandatory for entities operating in the zones to render tax returns and pay, or at least act as agents for taxes where they become due. In the above regard, three things have come into play. 1. Entities operating in the free trade zones are now required by the Finance Act 2020 to file returns. 2. They are required to pay taxes on goods produced in the zones, but which are not exported, but instead sold into custom area, that is, into the territory of Nigeria. And 3. Those entities are also expected to act as agents of collection for withholding tax and VAT and such other taxes that may become due from other players who come into the zone to construct or provide ancillary services. The FIRS followed all this up with a public notice which was released at the end of March 2021. In the notice, the FIRS stated that the Finance Act 2020 amended Section 18, subsection 1 of the Free Trade Zones Acts, and therefore gave notice to all enterprises registered and operating in the zones that the amendment mandated the enterprises to file income tax returns for year 2021 and subsequent years of assessment and to compute and pay income tax due, if any. And those returns should be in the manner and time specified by the company's Income Tax Act. The notice listed the FIRS tax offices where the filing can be carried out. It is against the same background that NEBSA came to Revenue House on Wednesday, the 8th of June to sign the Memorandum of Understanding. Chief Host, Executive Chairman FIRS, Chairman Joint Tax Board, put the day's event in perspectives.
The MOU is intended to foster greater collaboration between the two national agencies, that is the Federal Inland Revenue Service and NEBSA. And what we intend to achieve is to promote the smooth operation of activities of approved enterprises in the zone and ensure effective administration of taxes applicable in the operations of zones under the NEBSA. The reason why we've been a bit careful is that we have two mandates and the mandates are conflicting. We are asked to generate revenue for the government to be able to fund its budgetary requirement in order for government to be able to provide social amenities, provide critical infrastructure, ensure security and safety of lives and properties. And in your own case, you are asked to attract investment. So when we have situations like this, the need for this collaboration becomes very necessary so that we don't disagree in the course of pushing our respective mandate.
How did it all begin?
Available records show that NEBSA and FIRS have been working harmoniously together since the year 2010. And this laudable initiative for executing an MOU today is to further that collaboration.
Going forward, what does the MOU mean for operators in the free trade zones?
With the sign of the MOU, we are expected to have better working relationship that will promote the fulfillment of our respective mandates. While FRS will ensure that our operations and processes will not hinder the smooth operation of the approved or permitted enterprises in the zones, it is expected that the enterprises will be prompt in filing their tax returns, make remittances of taxes where applicable. Why we're insisting this is that the custom officials are here. In as much as you're operating in that zone, and about 75% of your product or the production is not exported out of Nigeria, then whatever you do and send to Nigeria becomes an importation into the custom territory. So we are doing this together with the two agencies so that the custom also are able to collect revenue that is due from those importations. At periodic intervals, in line with the MOU, FRA will have access to the zones to conduct compliance check. We are not only going to ask for revenue, we are going to also obtain data that we are going to transmit to the Ministry of Finance to say these are the taxes that you have forgone as a result of these incentives that you have given to enterprises in the zones.
Managing Director NEBSA, Professor Adesoji Adeshuba, gave a background to the setting up of NEBSA and, of course, the various free trade zones in Nigeria.
We have quite a number of successes that we can point to. When people say they are going to Dubai, Dubai is not a country. It's the country is UAE, but Dubai is a huge free zone scheme, which we all agree has been successfully implemented. For China, they've had a very, very useful scheme. When we started our own scheme, God bless those people who thought of the NEBSA Act. As a lawyer, I've gone through that act numerous times, and I've come to the understanding that it's the only truly one-stop shop for investment that we have successfully created. The act is very potent. It has the ability to actually propel this country if it is effectively managed. Now, for China, as I was saying, we started about the same time. For our act, they had started talking about it from the 80s. They eventually started it in 1992, and the first free zone was established in Calabar. China started about the same time, a little bit earlier, maybe about 3 or 4 years earlier than us. Right now in Nigeria, we have 2 public zones and about 22 active private zones. In China, they have about 3,600, and you can see the effect in their production and competitiveness using this same scheme. I am so excited that my brother and myself and our team have come to the understanding that tax regime under any scheme at all is very, very important. Taxation is a very key and critical part of the economy, and as such, as players in the economy, we must all work hard to ensure that what is due to Nigeria is paid to Nigeria.
Again, the question is, what does the MOU mean for operators in the free trade zones?
The interesting thing is that most people don't even understand that the free zone scheme, even though in quote free zone scheme, free of tax, free of duty, does not necessarily mean that tax is free, because the fallout from the scheme, the investments from the scheme, overflows into what we call the customs territory. So as we have 22 zones, but there are over 100 other companies and industries that service the zones from the scheme. So there is an interplay of the freeness to those who have to pay, of those who will pay VAT and those who will not. So we must, as a policy, track this In most advanced countries, filing returns is also part of capturing the statistics within the economy. I'm sure we also have tax credits here, where if you file your returns, that's when you will note whether you are entitled to a tax credit or not. So it's very key and very vital that we as a zone work together with the tax authorities to ensure that what is due to be paid, when it is due to be paid, will be paid. And if you are not paying anything in accordance to the law, we want to also know and note this.
At the end of it all, the Executive Chairman FRS and the Managing Director NEBSA appended their signatures to the MOU.
It is an offence punishable by a fine of 10 million naira and or imprisonment for any agency of the federal government other than FIRS to demand for books or returns for the purposes of tax. It is also an offence to carry out the function of assessment, collection or enforcement of tax or pay any portion of tax revenue to any person or into any account other than the relevant accounts designated by the Constitution or relevant laws of the National Assembly. It pays to pay your tax. This message is brought to you by the Federal Inland Revenue Service, FIRS.
You are still on to tax matters. Last episode, we began sharing with you what transpired at the two-day interactive training conference held for justices of the Supreme Court and judges of the Court of Appeal with a view, of course, to getting everybody on board in the quest for improving the quality of justice delivery in tax matters. As we told you on that outing, it was a two-day event, and on day one, 3 papers were presented. We have shared with you excerpts from the presentation of Honorable Justice B.B. Kayim, and we want to go straight to business by sharing with you excerpts from one of the 2 other papers, the paper on taxation of non-residents under Nigerian tax laws, presented by Mr. Matthew Bojumbola, Group Lead, Special Tax Operations Group at the FIRS.
The objective is to provide a general description of the application of Nigerian tax laws as regards taxation of non-resident persons, which includes individuals and corporate entities, and also to elaborate a little bit on the extent of liability of non-resident persons to tax under our law, and then look at a few emerging issues.
On what parameters or basis are personal incomes brought to tax?
There are 3 model taxation in the world. One is what we call the worldwide taxation rule or model, and which means that if you are considered a tax resident of a jurisdiction, all your income wherever arising in the globe, and if you make money on the sun or in the moon, become taxable in that your jurisdiction of residence. When you are a tax resident of a country that adopts the worldwide rule or the tax residence rule, then all your income, wherever they may be, wherever they may arise from, will become taxable. And that is what we adopt in Nigeria, and that is what majority of countries adopt. There are very few exceptions. Now, the second model is what we call the territorial model. And the territorial model is such that only income arising from that territory will be taxable in the hands of the taxable person. And such, all income earned outside that territory is exempt in that country. And very few countries do that. Ireland, for example, Hong Kong, Malaysia, Panama, these are the few ones, and Paraguay, that do territorial taxation. And then we have what we call the hybrid. The hybrid is a mixture of the worldwide taxation and the territorial taxation. And indeed, when we look at it, there is no country that actually does absolute worldwide taxation. What we have is actually an hybrid, in which case, for certain category of income, is only taxable. in the country of residence, and then for some is eliminated. For example, if you look at Section 23 of CETA, wherein we say income are in the category of interest, dividend, royalty, rent that is brought into Nigeria is exempt from tax. Of course, we know the policy drive behind that, which was to say we want to bring in dollars in order to attract foreign exchange into the country. So the law actually now says if you earn these 4 types of income from outside Nigeria and you bring the money into Nigeria, then we exempt it from taxation. Of course, there are also conditions attached to it by the law. So that makes our own system not strictly a worldwide taxation, but an hybrid of both worldwide and territorial form of taxation.
Mr. Bojumbola proceeded to emphasize the central place of residence in income tax administration.
Now, when we talk about taxation, particularly under the worldwide concept of taxation, the basic foundation on which it stands is tax residency. That is, where are you deemed to be resident for tax purposes? In other words, where will you be primarily responsible to pay tax? And that is why in all our income tax laws, issues of residence in one form or the other is very, very key. And that is what they call tax nexus. I mean, what attaches you to a territory for the purposes of payment of taxation. And so, when we talk about tax residency, we are talking about country of jurisdiction in which a person, which can be an individual or a company, is going to be liable. And so you are deemed to live in that country. We believe that you are domiciled in that country. We believe that your vital interests are in that country, and therefore you are liable to pay tax in that place. The English law talks more about domicile, and that's when they talk about the ordinary residence or ordinary domicile and all of that. But the whole essence is to say, where primarily are you liable to pay tax? Who is a resident of a country for tax purposes is a matter of the domestic law of that country. And so, for different reasons, you can see an individual or a company who has dual tax residence. For example, in Nigeria, as an individual, you are deemed to be tax resident in Nigeria if your place of abode on 1st January of the year is in Nigeria. That is the rule in Peter. Whereas, if you go to the United Kingdom, the tax rule there says for you to be resident in UK for tax purposes, if you visit UK, cumulatively, we add up the number of times you visit within 4 years, and it is up to 183 days. Then you are deemed resident in the UK, and then your income will become taxable. Now, if you are a frequent flyer or visitor to United Kingdom, and in 4 years, you are able to accumulate more than 183 days of sleeping in Britain, then you become tax liable. Meanwhile, you are ordinarily resident in Nigeria, you are tax liable. So double taxation kicks in for you at that point in time. So there is nothing illegal about it. It's a matter of the domestic legislation of each country or jurisdiction wherein you become economically active. Now, there's a big difference between tax residence and issue of domicile. Domicile talks about your place of abode for a long time. I mean, for example, me standing before you, if you asked me, where are you from, Gonjubola, I would say, I'm from Ilesha. Whereas, in a year, how many days do I spend there? So, for me, my place of abode or domicile, ordinarily, is Ilesha, because that is where I see as home all the time. But when it comes to tax, I pay my tax in FCT. Why? Because I work, I live here in the FCT. And that is actually the big difference between issue of domicile and issue of being tax resident. Because we have also seen cases where this two are juggled together and mingled together. They don't necessarily mean the same thing. That you are tax resident in a place does not mean you are domiciled there. Or that you are domiciled in a place does not mean you must be tax resident or be paying your taxes there.
Getting interesting, isn't it? Domicile Residency. Food for thought. In personal income administration, we have residents and we have non-residents. Of course, like Mr. Bojumbola said at the beginning, both concepts refer to individuals and corporate entities. So how are non-residents brought to tax? Remember that the title of Mr. Bojumbola's paper is Taxation of Non-Residents under Nigerian Tax Laws.
The next issue here is the importance, particularly when we are considering issues of non-resident persons in Nigeria for tax purposes. And when we say somebody is non-resident, it means that it's on the first day of the year, it's not here. It doesn't have a cumulative 103 days in 1 year living with us. It doesn't have its vital interest here or any of those things. So this becomes very key, because once you are not deemed to be tax resident, you may not become taxable. And that is usually a very key issue for determination in our tax disputes. And so it determines whether you are liable to tax in the first instance. Number two, it determines to the extent to which are you taxable. So for example, in Nigeria, if you are not tax resident in Nigeria, your worldwide income will not become taxable in Nigeria. But you may be selectively become taxable on certain aspects of your income. For example, if you have shares investment in Nigeria, you have shares, for example, and you earn dividend, under our law, the dividend you earn is taxable in Nigeria. Even though all the other income will not become taxable in Nigeria, but that which you earn here becomes taxable. And then it also determines the extent to which you can enjoy tax benefit under a tax treaty. So if you are not ordinarily resident in Nigeria for tax purposes, you cannot claim benefit under any treaty that Nigeria enters into for tax purposes. Now, so let's quickly look at what makes a person resident in Nigeria or not. For you to be resident in Nigeria, as an individual, you can't be domiciled in Nigeria. If you are domiciled, you are deemed resident. Or you sojourn in Nigeria for a period not less than 183 days in a year, in a 12-month period, then you become tax resident. Or you are a diplomat of Nigeria serving in another country, then you are deemed to be tax resident in Nigeria. So you pay your taxes here. So all our diplomats in all the countries where we have embassies, they pay their taxes there. They don't pay in the country where they are. Now, if you are a corporate entity and a company, for example, you are tax resident in Nigeria if you are incorporated under any law in Nigeria. So if a company is not incorporated under any law in Nigeria, you are not deemed to be tax resident. You cannot have what we call a fixed base or what generally is called permanent establishment, in which case you are treated as a branch and then you pay taxes as a branch. Again, you don't pay income, that company will not pay income tax based on its worldwide income. It will be limited to the income generated in Nigeria only. The flip of it is who is not a resident, and it's the opposite of everything we have said. To a resident, it's not domiciled in Nigeria, or it doesn't stay in Nigeria for up to 183 days in a year. It's not a diplomat representing Nigeria in another country, and it's a company that is not incorporated in Nigeria under any law.
Still on taxation of non-residents.
If you are not a resident now, what do we tax? If you have a trade or business or vocation or profession in Nigeria, any income that comes your way in Nigeria from that activity becomes taxable. If you are an employee and your employer is here and you are exercising the employment here, then even if you are not a resident, the employment income will become taxable in Nigeria. Yes. If you have these lines of income in Nigeria, irrespective of where you live, you earn dividend, royalty, interest, rents, fees, for example, directors' fees and whatever, whether or not you come to Nigeria, that income will become taxable in Nigeria.
We can go on and on with Mr. Bojumbola, but all we have done on this episode is to serve you snippets from what transpired at the Interactive Training Conference for Judges. We can confirm that Mr. Bojumbola did good justice to the topic, taxation of non-residents under Nigerian tax laws. Because of time constraints, we will not be able to go further than we have done on this episode. Next episode, we will be sticking with the story of the training conference. We will begin with the presentation of Professor Abiola Sani on jurisdictional and legislative powers on tax collection in Nigeria, pertinent considerations. And then we can see how much we can share with you on taxation of non-residents. In the meantime, we'll leave you with this profound statement of the Chairman of Session, Honorable Justice Datijo Mohammed.
We must always remember the advice of the last speaker, that it is fundamental for any country to exist in the first place, and if a country must exist, it needs the payments of taxes so to do.
Very profound. We have had great fun riding with you on this episode. We hope you did. So let's do this again next week. Same station, same day of the week, and same time of the day. Bye for now.